Take a look at these two charts on your screen. The chart above is the Nifty chart for the past 5 years. What do you see here? Nifty index has given close to 95% returns in the past 5 years, which on an annual basis translates to a return of close to 14%. So Nifty has given a rough CAGR of 14% in the past 5 years. Now take a look at the chart below. This is the Dixon Technologies stock chart for the past 5 years. The compounded annual growth rate, the yearly growth rate is 53% and the overall returns in the past 5 years is 743%. That's the kind of wealth Dixon Tech has made for its investors. So in this video, we are going to talk about what does Dixon Technologies do, their business in detail, what are their financials looking like, what are the major risks involved, and why do I think that Dixon Technology is a potential multi-bagger for you. So without any delay, let's begin. Dixon Tech is a leading contract manufacturer in India, which means that it manufactures the products of its clients. Dixon Tech operates majorly in two segments. One is the electronics segment and the other is the lighting segment. If you take a look at the major clients that they have in the electronics space, they have Panasonic, they have Samsung, they have Xiaomi, they have even OnePlus. So it manufactures the products that these companies make. In the lighting segment, they have Philips and Havells. So if you take a look at their overall client base, it is comprised of very good brands, and it's servicing the needs for those brands by manufacturing their products. But doesn't it sound a little odd when you hear that the company that manufactures the products of these brands is not the brand itself but another company called Dixon Tech? It might sound a little odd, but it's exactly what is happening in the current situation. A lot of these brands prefer to outsource their manufacturing and their production capacity. One, because it saves them a lot of cost because the investment into production and manufacturing capacities is a lot. Point number two is they will have to hire and they will have to train employees who can produce and manufacture products based on the standards that these brands and their products have. It is because of all these reasons that these brands prefer to outsource manufacturing facilities, and their own expertise lies in features like innovation, in customer experience, inventory management, supply chain management, and they try and take care of all those aspects. You'll be even surprised to know that Apple also doesn't manufacture its own iPhones. It's done by a company called Foxconn. So even our own Indian brands are currently involved in contract manufacturing as well. And Dixon Tech seems to be at the forefront when it comes to the contract manufacturing space in India because of their huge client base and because of the kind of performance that they have built over the past 5 years. Their IPO was subscribed by 116 times when it got listed in the market, and it was listed at a premium of 53% from its issue price. Now that we have taken a look at their overall client base and understood what Dixon Technologies eventually does, let us now try to find out their 5-year historical financial performance, and we'll take a look at their revenue and their profit chart for the past 5 years. If you take a look at their revenue chart for the past 5 years, there is only one trend that you are going to see, and that is an upward and an increasing trend in their revenue growth. This suggests that the business that Dixon Tech is able to acquire from its clients is increasing on a year-on-year basis, which is a very healthy sign for the overall growth of the firm. Similarly, if you take a look at the profit chart for Dixon Tech in the past 5 years, you will see a very similar trend, a continuously increasing trend with the profits rising on a year-on-year basis. Now, these two charts eventually suggest that the top line is growing at a healthy rate. The bottom line is also growing consistently, which would mean that the costs are very much under control for the management of Dixon Tech. Now, if you take a look at this particular chart that shows the revenue mix of each of the business segments where Dixon Tech operates, you will see that close to 68% of the overall revenues that Dixon Tech has comes from the electronic space. Another 16% comes from the mobile space, 8% comes from lighting. These three segments together contribute to close to 92% of the overall revenues of Dixon Technologies, and these three are also the segments which are destined to grow in the long term, because the demand for electronic appliances and for lighting products is going to go up in the future. But is everything working according to their plan? And do we not have any challenges in the path of Dixon Technologies? Absolutely not. In the next segment, we will now discuss the major challenges that Dixon Tech is going to face in their growth trajectory from here on. The biggest challenge for Dixon Tech, in my opinion, is because of the nature of the industry that they are currently operating in. Contract manufacturing in India has been a very low margin industry, and the reason for that is these companies have to back the contracts from the major players in the market, and to do so they have to make sure that the costs that they are giving to these companies, the quotations that they are giving, has to be kept at optimum levels, because otherwise they are going to run the risk of losing those clients and brands who have the opportunity to switch over to other manufacturers. It is exactly because of this reason that contract manufacturing continues to be a very, very low margin industry in India. The second challenge for Dixon Tech is going to be the very huge dependence that Dixon Tech has on its brands, on its clients. So tomorrow, if the brands or its clients are not performing up to the expectations, or the demand for their products go down, or if there's some problem with the overall performance of the brands, then these companies are not going to give enough orders to Dixon Tech for their manufacturing and production. So the dependence is extremely high on its clients, and the success for Dixon Tech is directly linked to the success of its clients. The third challenge for Dixon Tech would be the overall dependence on the industry growth. Now, I've just told you that 92% of the overall revenues that Dixon Tech makes comes from electronics, lighting, and mobile equipment. If this industry faces a crunch, faces a demand shortfall, then eventually Dixon Tech revenues are going to take a very big hit. And given the kind of dependence that Dixon Tech has on these segments, Dixon Tech's revenues will massively suffer if there is anything wrong that happens in the overall industry demand. The fourth and the final challenge, in my opinion, for Dixon Tech is going to be tackling the low manufacturing costs in China. A lot of these brands also prefer their manufacturing to be done in China, where the overall cost of production is very less, and China continues to boast of a manufacturing hub, delivering high quality products at very optimum costs. Dixon Tech will not just have to compete with the other manufacturers, other producers in India, but it will also face pressure from these brands switching over their manufacturing capacities to China. In my opinion, these are the major four challenges that Dixon Tech will have to face in the near term. But overall, let's now find out what is my personal recommendation for the Dixon Tech stock. So Dixon Tech has historically been performing extremely good in India, and given the kind of sectors that they are operational in, I do expect that the demand for such products is only going to go up, which would mean that at least the revenue part of Dixon Tech is going to be growing in the next few years. In fact, in FY22, the management expects the revenue to grow to 10,000 crores, which would be a 50% upside from the previous year. Hence, I do expect that there would be no pressure as such in the near term for Dixon Tech. Dixon Tech stock is currently trading in the range of 4,000 to 4,200, and I do expect that within a year or so this is going to go back to its initial highs of close to 5,500. I am extremely bullish on this stock, and I do expect another 15 to 20% of an upside from Dixon Tech stock. One, because of the nature of the industry that they are operating in, which continues to show an increase in demand as and when the economy is restored towards normalcy post coronavirus waves. Alright, I hope you enjoyed this video. Do subscribe to Finance Lens, and I'll see you the next time.